Well, I think it comes a little bit of a surprise when you contrast it from what some other governors had been saying just a couple of days back. But if you step back and look at it from a broader picture, it's not such a surprise. It's just yet another example of the Fed sort of coming down to where the market is. And the market and the Fed are both still looking for hikes, just keeping it very slow, very cautious, and maybe trying to deviate from the possible outcome that Fed might end up hiking rates very quickly, really trying to sort of, guide markets away from that.
It does seem like the consensus, at least in talking to analysts, that there will be 2 rate hikes this year. But given what we heard overnight from Janet Yellen, can we even expect that? Are we looking now at a perhaps July hike instead of June?
Well, markets were never really convinced by 2 rate hikes. I mean, if you think about what markets have been pricing in, even one whole rate hike has been a challenge for a large part of the year. But, for financial markets, that's a great thing. Inflation's not a worry. One of the concerns always was that the Fed may end up hiking rates by too much or too quickly. That ultimately ends up hurting financial markets. But, more dovish stance, that means those risks, if anything, have been reduced a little bit. It extends the environment a little bit for equities and high-yield bonds.
It does seem like we're getting a bit of a mixed message here, because we've heard the Fed say over and over they are data dependent. We've seen the fundamentals in place in the U.S. economy, and yet Janet Yellen coming out and saying it's actually the global risk that will delay the pace of the hikes.
Absolutely. And I think what was interesting is how she also focused that around the US dollar, because slower growth overseas does hurt. It ultimately hurts earnings. It hurts financial conditions. And a stronger dollar doesn't help. And what would really help both the inflation picture, the growth picture, is the dollar strength remains within control. And so far, that seems to be playing out.
So let's talk about China, because I know Janet Yellen specifically cited the slowdown in China as one factor here and looking at when to hike. You look at China, the data that came out over the weekend, industrial profits rose at its fastest pace in more than 18 months. A lot of people looking to that to saying, maybe that's a sign that the stimulus, that monetary easing is working. What do you think?
Well, I think it's within the longer-term trend of gradually slower growth. I mean, China for the past couple of years has been a story of long-term reform, but ultimately supporting growth in the short term in case it falls, too much. I think we're in one of those phases now where policymakers are trying to keep short-term growth on an even keel. We saw that with the fiscal expansion. But at the end of the day, we know on a trend basis, China's economy is slowing, at least at a headline level. It's part of the long-term rebalancing process. So the fact that we haven't seen any sharp growth, we've seen policymakers provide a bit of support when needed, that's a positive for the global economy.
So you think the markets are convinced that the policymakers in China have a grasp on how to control, or I guess maintain, this slowdown?
Well, I wouldn't say convinced, but I think one of the biggest risks for China ultimately is capital outflows in the currency. If you think about where the risks might tangibly express themselves. And having a softer dollar actually helps, because it reduces, depreciation pressure on the currency. It gives policymakers a little bit more room. So if anything, Yellen's comments, when you offset against that, actually help a little bit in making sure things don't fall off a cliff.